This is a great question. So talk about the trailing stops on gold. And then we're also going to talk in depth about directional bias. We'll cover that in the premium video, and how we know to short into a close once we get a certain degree of clarity. So let's start with gold. This is that 1309, 1305 level on April. Remember that we need to roll over into June. That's the 1314, 1309 zone here. We've taken out a number of potential upside targets, starting with 1336 and then moving into 1347, 1352. So there's just a few questions that we need to ask, and it's pretty simple. One is, have I taken profits, and how do I want to do that? So one choice is just to be proactive and use those Darvis levels that we just talked about. Crossing up higher through 1336, crossing up higher through 1347. That's one choice. The other would be the intraday, what I call trailing stop trade. And that is finding an uptrend that accompanies the strength we saw in gold. And if and when we roll over, and I've talked about the trailing stop trade being anywhere from 1351 to 1349, it looks like that might be happening. And this is a great way to kind of sometimes eke out a few extra points. So until we roll over through, say, 1351, you can hang on. We're getting really, really close right now into the close. But this is an effective way to very tactically and prudently eke out maybe a few extra points, especially for those of you that really want to get the most out of maybe a single contract. Now, transitioning to a trailing stop is asking a very specific question, and that is, do I have it to give back? And I love this question because then it keeps you from starting to overly aggressively trail a stop. So the question then becomes, do I have it to give back? Or what do I have to give back? And that's going to be answered by your entry price and the current level. So take the current price level, 1352, subtract your entry price, 1309. It's pretty easy to see. We have plenty of points to give back, well over 30. And the reason I kind of round it out is it's really easy when you go to the daily price movement by day of week. We're 2x. We have two daily price movement ranges of unrealized profit, meaning if you want to trail a stop by 16 points, that's absolutely fine. It's the typical price movement range, the high for the week, and it allows you to be able to absorb a 16-point sell-off, trail a stop, and lock in the remainder as profits, because trailing stops usually imply that we're protecting some percentage of our profits. Not all of them, but some percentage of our profits. That's the implication here. And if the implication is, I want to move to something that locks in profits, we have a saying, show me your stop loss, and I'll show you your P&L. If I'm protecting profits, I've moved to a trailing stop. Do I have at least one daily price movement range to give back on the daily time frame trade? I absolutely do. That means under that criteria, it is valid to transition then to a trailing stop. And not that it's always this way, but a general rule of thumb is once you've crossed over two profit targets, you really should have at least one daily, if not more, in terms of price range of unrealized profit, or even realized in this case, because we've taken out, we've scaled out of this twice now. So that's how we do the transition with the trailing stop. And it's something that served me very well. It's very systematic. It's very objective because I'm measuring not dollars, but I'm measuring the price movement range of the symbol. So I'm respecting its nature and what it tends to do.